Hello from the Dukascopy TV studio in Geneva. We are talking about the relevance of impact investment with Mr. Fernando Scarpati. He is Senior Partner and Private Equity Director of IMC Consulting International. Welcome to the studio.
Thank you, Daniel. Thank you.
Actually, Mr. Scarpati, what is impact investment and why did it receive such a great amount of attention in the recent months?
Okay. Impact investment is something very new, and it has to do with investments when we combine financial return with social and environmental impact. Yeah, both things together. This started in the 90s when investors started to realize that some investments were causing bad effects to the environment. In the 90s, we had a first name for this kind of new investments, which was blended value. Finally, this started to develop in the 2000s, and in 2007, it came the term for the first time impact investment. So we have very little experience. We are starting to learn about this. Just to give you an idea, the size of this market is right now worldwide is 40 billion, next to 2 trillion euro of the whole private equity investment, and next to 250 trillion of the financial markets. Okay?
Mm-hmm. So to ask what are the benefits for the investors, can investors be sure that the risk-return trade-off is right?
Well, this is a very, very good question, and I think it's the key of everything. And I will start by telling you that the main problem we have, it's history. We don't have history. You know that financial markets are based on history, returns. So investor looks at past performance and then they invest. Here we don't have history, so we have to deal with other parameters to make sure that they are convinced about the risk-return trade-off. So the most important thing is that after 2007, after the crisis, you know that in the past, traditional assessment, value assessment, risk assessment had to do with capital asset pricing model and with illiquidity and other things. After the crisis, investors realized that this is not enough. Yeah? This is not there was some problems. So for the first time, investors are looking at other drivers, value drivers, like strategy, like the management team, like the mission, the concept of the fund, the sectors, and many other things. So it's just about showing them that we can provide and deliver alpha returns by generating at the same time impact investment.
So, of course, a question every investor would ask, do these kind of impact investments generate the same returns on investments such as traditional investments?
Yes, absolutely. Absolutely. This has to do with the budgeting at the beginning. Yeah? When we select a deal, of course, this is not going to happen in all deals, and it depends on the sector. Yeah? Some sectors will be able to generate better returns than traditional deals. So we have to choose the right deal and budget the risk-return trade-off and at the same time the impact investment of that deal.
And you brought some charts with you today to...
Yes, I can show you this first chart, which shows, as you can see, the traditional perspective in which we have the return in the epsilon axis and the risk in the x-axis, and the risk-adjusted return, which is the line, the blue line. So all investments over the line create value. All the investment below the line destroy value. So this is the typical traditional assessment and capital based on capital asset pricing model. Instead, right now, if we consider impact investment, we can go to the next figure. We have the same situation, but with a new dimension, yeah, which is impact investment. So now, when we plan, when we budget a deal, we have to think about risk, we have to think about return, and we have to think about impact investment. Yeah? But the important thing is that impact investment should be correlated with returns. Yeah? Should be correlated with returns. We must be sure about that. Okay? And the cake there is showing a study made in the United States in which still some investors think about financial as first scope and impact 10% as a first scope, and there is a double bottom line. Of course, the first two are not impact investment. Yeah, the double bottom line is impact investment. And this is showing the value chain we must consider and show to the investors when we are involving them in a deal. So we have an input, we have an output. The output is going to be the financial return. The outcome is going to be the change we are going to generate in the society, in the environment. And the impact, which is also the outcome, but considering what would have happened if we wouldn't have done the investment. Okay, so it's adjusted considering that.
And so finally, so what does this mean in terms of the alpha? Is it necessary to sacrifice the alpha now when looking for a good cause? And other way around, is it possible to generate superior returns maybe through impact investment?
No, absolutely. We must concentrate on generating alpha like traditional or private equity funds. Also in impact investments. We must do, we are able to do that, and we must do that. And the way to do it, as I told you, is to budget in advance the risk we want, the return we want, expected return, IRR, and the impact investment we want. Yeah, there will be a framework, and we will present that target to the investors in order to start the deal. Obviously, in the risk-return trade-off, there will be considered an alpha abnormal return, as in any private equity fund. Otherwise, if we don't do this, we are falling into philanthropy. Yes. So if we have to add a cost to create social impact, then we are doing philanthropy and not impact investments.
Fernando Scarpati from IMC Consulting International, thank you very much for being here today and sharing this information with us.
Thank you.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.